All right, let's talk more. You're going to stay with us, Rick. Let's talk more about stimulus and what happens now. Joe Brusuelas, there he is, RSM Chief Economist, is joining us now. I like your new shot, Joe. Let's talk about this stimulus wrench, if you will. What does happen now? I mean, there were a lot of complaints from economists and individuals alike that $600 was not enough. But is there a possibility of getting larger checks in there at this point?
Well, it's not enough. It should have been double. But look, we have to bow to reality. And the reality is the Democrats would unanimously pass what Mr. Trump asked for last night, right? But the GOP and the Senate simply won't do that. So we now have to look at the state of play, which is government runs out of funding on December 28th, right? So they're going to have to figure this out. If that involves a veto or a pocket veto that's overridden by the Senate or by the Congress, then that's what this involves. We've looked at the legislation. You know, inside the National Defense Authorization Act, there's language that allows them procedurally to go back and just override the president. So this is something that I think markets right now, investors think, well, this legislation is going to get passed largely as is, and that's why we're not seeing an upset. But that may be a little too simplistic. If we get into a protracted standoff that goes all the way to January 3rd, which would be the last gasp of the 116th Congress, you will see consumer confidence, corporate confidence take a big hit, and you'll likely see equity markets sell off and bond yields fall. But, you know, look, if you looked at the jobless claims data this morning, and I really want to emphasize this, everybody out there, there are 20.3 million individuals on some form of unemployment benefit. This is no time to be delaying aid to the millions who are at risk of eviction, hunger, and unemployment just ahead of the holidays. This, to me, is just beyond the pale. Congress needs to get together with the president. They need to get it done. And hey, if the GOP Congress has to, or GOP-led Senate has to accept something that they don't want to, well, that's fine. But there's real need out there. This economy, while I'm very bullish on what the second half of 2021 is going to look like, still in a crisis, the pandemic's raging out of control, and there are just millions of people out there who need that help. Don't discount what $600 means to one or two people or a 3 or 4 person family. It can mean everything.
Joe, my friends at Evercore ISI just shot me over this note, and they said if the president doesn't sign this stimulus plan, it could send the U.S. economy into a tailspin. Do you agree? And what does an economic tailspin look like at this point?
Okay, so the one thing, you know, if you're looking big picture about the budget and pandemic relief act was it was going to put a floor under the economy in the first quarter. Well, current quarter, we're going to grow 2.7%. We're decelerating rapidly from that 33.4% rate of growth in the third quarter. However, if nothing's done, we're going to have a negative handle on GDP in the first quarter, right? So that means another economic downturn, and it creates the conditions for a classic double dip recession. Now, here's the thing. This is just one of the more interesting things I've ever seen in my career arc. We would be going into recession by choice. This is something that the political actors in Washington have the power to prevent, and they should act to prevent it. But if they don't, if this just continues well into January, nothing gets done, we're likely to see a double dip, and that will create conditions that will delay recovery and create an expansion that's weaker than it otherwise has to be. And of course, it will create significant pressure for the 117th Congress and whichever party controls the Senate to really work with the incoming Biden administration to put forward a fiscal aid bill. Now, I want to make sure I say something here. It's very clear out there. This is not a stimulus. Anybody who's using the word stimulus it's a misnomer at best, and it's misleading at worst. This is direct aid to the American people who really are in need of it in this holiday season.
Hey, Joe, the other Joe Biden, says he wants more stimulus once he takes office next year. What do you think is possible in a Biden administration? And what would be the smartest, let's call it relief since you don't like stimulus, what would be the smartest package to do a few months from now?
Well, what you'd want to do is, do the same thing essentially, because what I prefer is that they double the direct aid to the family, 600 extra a week, and extend unemployment benefits for everybody to the end of next year. I think the incoming Biden administration knows that the number one priority is get their arms around controlling the pandemic. Without getting the pandemic under control, you're not in control of the economy. If an aid package is passed now, they can go back and take another bite at it. And then the big thing is, once the pandemic's under control, we've got to address the infrastructure problem. We have to modernize the national infrastructure. I think that we ought to construct an infrastructure bank, seed it with capital over 5 years, say to the tune of $300 billion, then use the deep and broad American capital markets to leverage that up 7 to 10 to 1, so we can really put 2.5 to $3 trillion over a decade or more towards modernizing the infrastructure that we have and modernizing our economy. And also, it's very important that we do this in public-private partnerships, that we utilize the financial system and the banks to make this happen. I mean, we just can't miss this opportunity. When inflation-adjusted interest rates have negative handles in front of them, this once-in-a-lifetime opportunity, we just can't miss it.
Well, if what's going on right now is any indication, it doesn't give one a lot of optimism. But again, to sort of set the scene for what you're talking about, potentially, if we don't get this aid package, which you're right is probably a good way of describing, a better way of describing it. You mentioned the jobless claims numbers. We also got November spending and income numbers. Spending in November down 0.4%, income down 1.1%. So under the scenario where we don't get this package through, after all, how much worse could those numbers get?
Well, what you will see is that individuals will pull back on spending in December, and it's going to be more of a bah humbug holiday. You know, I've been talking to clients in the press about what a K-shaped holiday looks like, where those in the upper path who were able to thrive during the pandemic, they thrive in the virtual economy or the Zoom economy. They're going to be fine, but it's the lower path of the K, right? You can see that in the wage data, and unfortunately here in the income data, it does tend to support a very weak traditional holiday spending season. November is when this is supposed to be kicking off. You should see spending, really spring forward here in November, December, and into January, and it's just not happening despite all the discounts, all the efforts by the retail complex to move their product. I think that the delay in providing direct aid to the American public once it expired late summer into early fall, in retrospect, was a major policy error. And you're now beginning to see that in the economic data. That decline in personal income should be eye-opening to everybody. And if you open up the data and look underneath it, right, inflation-adjusted spending declined by 0.4%, and the savings rate still elevated well above 12%. That just gives you a sense of people just aren't willing to go out, take risks, spend money ahead of the holidays because of the uncertainty caused by the political authority.
Joe, if we get that second half growth spurt that you described, will stocks go up along with that, or will the stock market be out of gas by then?
Okay, so my sense here is that if we're going to see an unleashing of pent-up demand, take that savings rate, Rick. The U.S. savings rate is $1.25 trillion at the very least, above pre-pandemic levels. We have an economy that's operating at about 79% of capacity. That means 21% of a $21 trillion economy is impaired. You begin to unlock that activity, you're going to see a different form of growth like we haven't seen since the Clinton era, late 1990s. My sense is that the way in which the indexes are balanced, which are tilted towards what I'd call the new economy, technology, telecommunications, media, life science, finance, the economy you see along the coast in the major hubs, stock market's going to take off. simply because that represents new growth. It will also represent organic growth. Second, the Fed's going to keep the federal funds rate at zero until the end of 2023. So money's going to be sloshing around the system, and you're going to see risk appetite increase. As I expect to see a modest steepening of the yield curve, improve financial conditions, and actually, I would think probably by the end of the third quarter of next year, lending conditions are going to improve significantly as lending officers want to take more risk and really take advantage of what's going to be a true boom in the second half of next year. And I know we're at the holidays. I know people are hurting. And to some out there, this is almost an affront that I'm thinking about the stock market as a forward discounting mechanism and growth averaging somewhere close to 5.5% to 6% in the second half of that next year. But that's our K-shaped economy that we have, and we have to begin addressing it.
Yeah, unfortunately so. Joe, very different conversation than we expected to have at this time yesterday with you. We appreciate it. We appreciate you rolling with it. Thanks so much for joining us, as well as our Rick Newman, as always, for rolling with it. Thanks, guys. Talk to you soon. Happy holidays.